Hi guys. Today we will analyze Microsoft stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Company Overview. Microsoft Corporation is a technology company. It develops and licenses consumer and enterprise software. It is known for its Windows operating systems and Office productivity suite. The company is organized into three equally sized broad segments: productivity and business processes, like legacy Microsoft Office, cloud-based Office 365, Exchange, SharePoint, Skype, LinkedIn, Dynamics, Intelligence Cloud, infrastructure and platform as a service offerings Azure, Windows Server OS, SQL Server, and more personal computing, Windows Client, Xbox, Bing Search, display advertising, and Surface laptops, tablets, and desktops. It markets and distributes its products and services through original equipment manufacturers, direct, and distributors and resellers. Company news. Microsoft will pay Activision Blizzard fee of $2 billion, if termination notice is provided prior to January 18, 2023 under specified circumstances. Microsoft has agreed to acquire leading video game company Activision Blizzard in an all-cash transaction for $95 per share. No change expected to previously announced share buyback program. Microsoft says, it observed destructive malware and systems belonging to several Ukraine government agencies. Microsoft has stopped manufacturing all Xbox One consoles to focus on producing its next-generation consoles. CMA launches merger inquiry on anticipated acquisition of Nuance Communications by Microsoft. Technical analysis. The long-term trend is still positive, and the short-term trend is neutral. The stock is creating consolidation between $305 and $345 per share. The long-term trend may just continue, or reversal may happen at any moment. Microsoft is currently trading in the middle of its 52-week range. The S&P 500 index, however, is trading in the upper part of its 52-week range, so Microsoft is lagging the market slightly. When comparing the yearly performance of all stocks, Microsoft is one of the better performing stocks in the market, outperforming 83% of all stocks. It's one of the better performing stocks in the software industry. It outperforms 91% of 350 stocks in the same industry. Microsoft has an average volume of 28 million. This is a good sign, as it is always nice to have a liquid stock. Company strengths. Microsoft is the world's largest independent software developer. The company is one of the few companies with a product set aimed at enterprise efficiency, cloud transformation and collaboration, and has a large and loyal customer base. Microsoft has large cash cushion and rock-solid balance sheet as important differentiators. It has about doubled its market share to 20% in public cloud infrastructure over the last few years. It remains in the number 2 position, well behind Amazon Web Services, but still well ahead of other competitors. Microsoft is also one of the few tech companies that pays a dividend, and its dividends are safe. Risks. The company is exposed to economic risk from foreign currency exchange rates, interest rates, credit risk, equity prices, and commodity prices. Supply shortages can dampen sales of Microsoft's own hardware products, like the new Xbox Series. The company faces intense direct competition from Google in many areas, including Internet search, operating system software, and Internet-based software applications. This competition could potentially erode the dominance of Microsoft's core operating system and Office applications. In the case of the Xbox 360, highly aggressive pricing from both Sony and Nintendo may hamper Microsoft's efforts to generate acceptable long-term profits in this area. Past performance. It's important to look at past performance, because it helps to make future forecasts about how the business is going to perform. If a company doesn't have a proven track record of performance, or a company had inconsistent earnings and revenue in the past, then it's very difficult to predict future performance of the company. Microsoft has a proven track record of good performance in the past. The company's earnings have grown by 27% per year over the past 5 years. Revenue was growing as well. The earnings per share has grown by 36.03% over the past year. Now we want to see that the company was able to grow its profit margins in the past. Expressed as a percentage, profit margin indicates how many cents of profit has been generated for each dollar of sale. The company's current profit margin is 39%. This is amongst the best returns in the industry. The company's profit margins have grown by 31% per year over the past 5 years. The company has a return on assets of 20.24%. This is amongst the best returns in the industry. Return on equity of 44.67% is amongst the best returns of the industry. Future growth. Future revenue growth is expected to be around 14% per year. P/E ratio compares the company's current stock price to its earnings per share, which helps determine if the stock is fairly priced. A higher P/E ratio shows that investors are willing to pay a higher share price today, because of growth expectations in the future. The high P. for example ratio, which compensates the P/E for growth, indicates the company does not grow enough to justify the current P/E ratio 33. Future return on equity is expected to be high in next years, more than 30%. Earnings per share are expected to be 16% per year. Financial health. One thing we look at is debt-to-equity ratio. We want to know if the company has any debt, and if so, is the debt affordable? The company has more cash than its total debt. Debt-to-equity ratio has reduced from 106.6% to 35.1% over the past 5 years. Short-term assets, $174.3 billion, exceed its short-term liabilities, $80.5 billion. Dividend. Dividends provide protection in down markets, giving investors access to cash, either to spend or to buy more stock after prices have fallen. Microsoft's dividend yield is 0.82%, 62 cents quarterly. Dividend payments are stable. The company has increased the dividend from $1.59 to $2.30 per year for last 5 years. Current payout to shareholders is 25%. Shareholders. Shareholders have not been diluted in the past year. It's important to know major shareholders of the stock because they can influence the outcomes of the business's voting decisions. See top 5 institutional shareholders of the stock. Those companies are solid. That's a good sign for investors. Now let's see if the current price of the stock is fair. Please look at the spreadsheet below. We use discount rate 10%. EBITDA multiplier is 30.92, it's a standard for the industry. How it works: if future market cap, in 2026, is less than the current market cap, today, the stock is overvalued. According to calculations in the spreadsheet below, Microsoft's market cap will be $2.378 trillion in 2026. However, even today we have pretty similar Microsoft's market cap $2.28 trillion. It means that with the current high stock price, $303, there is no too much growth for the stock by 2026. So, the stock is currently overpriced. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use 2 different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 16% per year, for last 5 years. Also we see that the average profit margin of the stock has been around 31% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 98% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Microsoft Company: bad, average, and good. First scenario. Microsoft will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 8%. Future profit margin would be a low, 20%. Future free cash flow to net income rate would be a low, 85%. In this case, the fair value of the stock today would be $112. The second scenario. Microsoft will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 12%. Future profit margin would be average, 25%. Future free cash flow to net income rate would be average, 94%. In this case, the fair value of the stock today would be $173. The third scenario. Microsoft will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 16%. Future profit margin would be high, 31%. Future free cash flow to net income rate would be high, 98%. In this case, the fair value of the stock today would be $253. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Microsoft is 8.94. Minimum rate of return. I will use 12%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Microsoft, analysts forecast growth rate around 16.52% per year in next 5 years, and future PE around 28. Again, I will use 3 different scenarios for Microsoft company: bad, average, and good. First scenario. Microsoft will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 8%. Future PE would be low, 14%. In this case, the fair value of the stock today would be $90. Second scenario. Microsoft will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 12%. Future PE would be average, 18%. In this case, the fair value of the stock today would be $161. Third scenario. Microsoft will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 14%. Future PE would be high, 25%. In this case, the fair value of the stock today would be $262. As you can see, today the stock is overvalued, $303, even if we expect Microsoft's high performance in future. It's a good company based on its fundamentals. However, the current price of the stock is too high. I would be happy to buy the stock when it drops below $230 to $250. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.